So today we're going to tackle a classic Wall Street puzzle. What happens when a fast-growing company's stock suddenly hits the skids? And the experts, the people who analyze this stuff for a living, just can't agree on what's coming next. Well, we're going to dive deep into exactly that scenario, looking at the conflicting analyses of a really fascinating company, Topicus.com.
So first off, who is Topicus.com? Well, they're a European tech company that makes something called vertical market software. Now, that's just a fancy way of saying they build super specialized software for very specific industries. Think finance, healthcare, you name it. The key is, instead of a one-size-fits-all product, they create these custom tools that get woven right into how their clients do business.
Okay, so here's the twist. Even though they sound like a solid business, their stock has had a really, really rough year. As of March 2026, it's down over 23%. Yeah, a drop like that would make anyone a little nervous.
And that, right there, is the big question. A steep drop like this can mean one of two things, right? It could be a huge warning sign that there's trouble under the hood, or it could be a massive buying opportunity. So which one is it?
To get to the bottom of this, we're looking at reports from two heavyweights in financial analysis, Morningstar and CFRA. They're both looking at the same company, the same data, but, and this is the fascinating part, they come to totally different conclusions using their own complex computer-based models. And that is the analyst's dilemma. All right, let's start with the bulls. We're looking at Morningstar's view, and they see this stock drop not as a red flag, but maybe, just maybe, as a huge opportunity. And Morningstar does not mince words here. The report from March 19 says, flat out, that they believe the stock offers a compelling opportunity. I mean, that's about as strong a bullish signal as you can get. They're practically screaming that they see a lot of upside from here. So, just how much upside are we talking about? Well, their model crunches the numbers and spits out a fair value for the stock at almost 131 Canadian dollars. Now get this, at the time of the report, the stock was only trading for about 97 bucks. And you can see it plain as day on this chart from their report. That top line on the gauge, that's their fair value estimate. And that little black dot, that's where the stock was actually priced. So according to their math, this thing isn't just a little cheap, it's trading at a massive 26% discount. So why are they so confident when the market seems to be running the other way? Well, their entire argument really hinges on a core concept for long-term investors, a company's competitive advantage. Morningstar's confidence really boils down to this one specific rating they give the company, a narrow economic moat. And that little castle icon they use, that is no accident. It's a perfect metaphor for a kind of fortress that protects a company from all its rivals. So for anyone who's not familiar, an economic moat is just a term for a durable advantage that lets a company fight off the competition and keep making great profits for years and years. It could be things like high switching costs for customers or a brand that everyone trusts. And Morningstar is saying Topicus has one of these powerful defenses. And the really important thing here is that this isn't some new development. This chart shows the company's economic moat rating over time. And as you can see, it has consistently been in that narrow moat category for years. If you're a long-term investor, that is exactly what you want to see, a stable, lasting competitive advantage. But, and this is a big but, even the bulls have their worries. Buried deep in that same super optimistic report is this little note of caution. Morningstar themselves point out that the company's low profitability is a potential problem. So even their 5-star rating comes with a pretty big asterisk. Okay, so now let's flip the coin and hear the other side of the story. We're turning to CFRA's report. They're looking at the exact same company, but man, their conclusion is a whole lot more cautious. Instead of compelling opportunity, CFRA's official recommendation is one simple, powerful word: hold. Now that's not a sell rating, but it's definitely not a buy either. They're basically telling investors, hey, maybe just pump the brakes and wait on the sidelines for a bit. To see why they're so cautious, we gotta look under the hood of their model. You can see here that valuation and quality both get a positive rating. So they agree, the stock looks cheap and it's a good company. But then you get to the bottom, and oof. Price momentum is a big, flashing red negative. And price momentum is just what it sounds like, the tendency for a stock's price to keep going in the direction it's already going. And right now, that direction is down. And CFRA basically just tells us this directly in the report. This quote spells it all out. their model is locked in this epic tug-of-war. You've got the positive valuation pulling it toward a buy, but that awful recent stock performance, that negative momentum, is yanking it right back to hold. So, here we are. The two viewpoints are on the table. This is where you can really see the dilemma, right? It's that classic Wall Street fight, value investing versus momentum investing. Let's just put them right next to each other. On one side, you have Morningstar with a 5-star rating, seeing a compelling opportunity because of long-term strengths and a cheap price tag. And on the other side, you have CFRA saying hold because its model is waving a huge red flag about the stock's recent nosedive. You know, what's really fascinating is where they actually agree. Both of their models think the stock is undervalued, but where they completely diverge is on what matters most. For Morningstar, who takes more of a value approach, that discount plus a strong moat is a clear signal to buy. But for CFRA, which puts a lot of weight on momentum, that same discount just isn't enough to overcome the ugly downward trend. It really all comes down to what you prioritize as an investor. So what are we supposed to do with all of this? What's the takeaway here? Well, the goal isn't to figure out which analyst is right. The real goal is to combine both of their perspectives to build a much more complete picture for ourselves. And it really just boils down to this simple idea. Morningstar is playing the long game, looking at the company's durable competitive advantage years down the road. CFRA's focused on the here and now, warning us about the stock's very real, very negative performance today. And you know what? Both of them have a valid point. So let's lay it all out. The pros, this company has had fantastic revenue growth. Both reports agree it looks undervalued, and it's got that strong defense, that economic moat. The cons, the stock's performance has been, frankly, terrible. Morningstar itself flagged that profitability is a concern, and CFRA's model is screaming about that negative price momentum being a major risk. And that brings it all back to you. This whole exercise shows us that expert analysis isn't about finding some single magical right answer. It's about understanding the different ways to think about a decision. So the final question isn't really about Topicus.com. It's about your own philosophy. How do you personally balance the promise of long-term value against the very real pain of short-term risk?